A year ago, this company was worth $877 billion, one of the most valuable businesses on the planet. Today, it's lost nearly half its value. Oracle, down 43% in 12 months. But here's the twist that makes this one fascinating. While the stock was collapsing, the business booked the single largest order backlog in its history, bigger than the entire company is worth. So which one is telling the truth? The price or the pipeline? Stick around because the answer comes down to one number most people are ignoring. Oracle isn't a startup. It's a 40-year-old software giant that reinvented itself into an AI cloud powerhouse. $67 billion in revenue last year, up 17%. We'll run this in 3 parts: the business and why Wall Street is obsessed, the risk that's crushing the stock, and the chart. Then a verdict, and the one metric that settles the whole debate. Part 3 is where most people get Oracle completely wrong. Let's start with why the bulls are so excited. 1. Cloud growth is exploding. Oracle's total cloud revenue jumped 39% to $34 billion, and its AI infrastructure business, the one that rents computing power to run artificial intelligence, grew a staggering 93% in a single year. 2. The backlog. This is the headline. Oracle's remaining performance obligations, that's signed contracts it hasn't delivered yet, hit $638 billion. That is not a typo. It's roughly 1.5 times the entire company's market value. Years of revenue already under contract. 3. Wall Street still believes. Even after the crash, the average analyst price target sits around $250, implying the stock could nearly double from here. 37 of 40 analysts still rated a buy. Record growth, a historic backlog, and a stock that just got a lot cheaper. So why has it fallen off a cliff? Here's the uncomfortable truth. Oracle is spending money it doesn't have yet. To build the data centers behind that AI backlog, Oracle poured $55.7 billion into capital spending last year. And next year, guidance goes up to $95 billion. The result, free cash flow was negative $23.7 billion. Read that again, negative. Even though operating cash flow rose to $32 billion, the build-out swallowed it whole and then some. And it's being funded with debt. Oracle's total debt has ballooned past $130 billion. It sold $18 billion in bonds, then $25 billion more, and plans to raise roughly $40 billion next year. The market noticed. S&P cut Oracle's credit rating to BBB-, one notch above junk, and the cost to insure its debt against default hit a record high. That's the fear, in one sentence. A $600 billion backlog is only worth something if Oracle can afford to build it. So here's the scorecard. On one side, 93% AI cloud growth, a $638 billion backlog, and analysts calling for the stock to nearly double. On the other, deeply negative free cash flow, exploding capital spending, a mountain of debt, and a credit downgrade. Genius bet or bubble? For that, we go to the chart. Fundamentals tell you what. Technicals tell you when. And right now, Oracle's chart is ugly. The stock trades around $144. But look at the moving averages. The 50-day sits all the way up at 183. The 200-day, near 197. Price is far below both. That's a textbook downtrend, a stock in a clear falling channel. Momentum? The relative strength index is around 33, right at the edge of oversold. Beaten down, but not yet a screaming reversal. The levels that matter. Support sits in a zone around 140 to 141, with a deeper floor near 132. If that breaks, there's not much below it. Resistance is way up at 181 to 183, right where that 50-day average is waiting. Oracle has to reclaim that zone before anyone can call the downtrend over. So, genius or bubble? Here's the honest framework. The bull case is real. No other company on Earth has a $638 billion backlog. If Oracle delivers even most of it, today's price could look like a gift. But the bear case is just as real, and it's specific. This only works if all that spending turns into cash, before the debt becomes a problem. Which brings us to the one metric that settles the entire debate. Free cash flow. Right now, it's negative $24 billion. The quarter Oracle's free cash flow turns positive, proving the backlog is converting into real money faster than the debt is piling up. That is your green light. That's the signal the bulls were right. Pair that with a technical breakback above 183, and you'd have the business and the chart finally agreeing. Until then, Oracle is the highest stakes bet on the market, enormous upside, and a real risk of a debt-funded stumble. A name to watch with both eyes open, not to chase blindly. That's the full breakdown, the backlog, the debt, and the why behind all of it. If this helped Oracle make sense, subscribe. Every week, we break down one New York Stock Exchange company exactly like this, so you can invest with a framework instead of a feeling. The free breakdown sheet, with all the numbers, is linked in the description. Quick but important, this channel is for education and analysis only. It is not financial advice, and I'm not your financial advisor. Do your own research or talk to a licensed professional before investing a single dollar. What company should we break down next? Drop the ticker in the comments. See you in the next one.